Hello everyone, welcome to this video of IAS 24 related party disclosures. In this video, I will be discussing how the standard is part of IFRS and focuses on how companies should disclose transactions and relationships with related parties. I will explain what the standard is about, why it's important, its scope, key definitions, disclosure requirements, and I will also walk you through an example and an exam style question. IAS 24 mainly deals with transparency in financial reporting. It focuses on relationships and transactions between a company and parties that are closely connected to it, such as owners, management, or group companies. The key point to remember is that IAS 24 does not stop companies from entering into related party transactions. Instead, it ensures that these transactions are clearly disclosed so users of financial statements are aware of any possible influence on any company's performance or position. The main purpose of IAS 24 is to make financial statements more reliable and trustworthy. Related parties may influence decisions in a way that independent parties cannot. For example, a company might sell goods to its subsidiary at a lower price or give interest-free loans to directors. Without disclosures, users may not get the full picture. IAS 24 help investors, lenders, and other stakeholders understand whether profits or balances are affected by personal or group relationships. IAS 24 applies to all entities preparing financial statements under IFRS. It covers relationships such as parents and subsidiaries, associates, joint ventures, and key management personnel. It also includes close family members because they can influence decisions indirectly. An important point is that disclosure is required even if no transactions took place as long as the relationship exists. Not every business relationship is considered a related party. For example, normal dealings with banks, suppliers, or customers are not related party transactions unless control or significant influence exists. Government bodies acting as regulators are also excluded. However, government-related entities may use limited disclosure exemptions, especially when transactions are common and not significant individually. To apply IAS 24 correctly, it's important to understand a few key terms. A related party is someone who controls, jointly controls, or significantly influences the entity. A related party transaction is any transfer of resources or services even if no money is involved. Key management personnel are people like directors and senior executives who make major decisions. Close family members are included because their actions can also affect the entity directly. IAS 24 itself does not tell us how to record transactions in the accounts. Instead, it focuses on identifying related parties and ensuring proper disclosure. Even if a transaction happens at a market price, disclosure is still required. Also, relationships must be disclosed even if no transactions occur during the year, which is a common exam point. IAS 24 does not introduce its own measurement rules. Transactions are measured using the relevant IFRS such as IFRS 9 or IAS 16. However, IAS 24 requires entities to state whether transactions were carried out at arm's length, meaning normal market terms. If they were not, the company should not suggest that they were unless there is proper evidence. The standard requires several disclosures. First, the nature of the relationship must be explained, such as parent, subsidiary, or director company. Then, the amounts of transactions during the period are disclosed, along with any outstanding balances at year end. Terms and conditions, including guarantees, must also be mentioned. These disclosures help users access the impact of related party dealings. IAS 24 requires disclosure of total compensation paid to key management personnel. This includes short-term benefits like salaries, post-employment benefits, and share-based payments. The disclosure is made in total, not for each individual manager. This protects privacy while still maintaining transparency for users of financial statements. Let's look at a simple example. Suppose a company sells goods to its subsidiary at a discounted price. Since a subsidiary is a related party, the company must disclose the relationship, the value of sales, and any outstanding balance. It must also clarify whether the transaction was done at market price or not. This ensures users understand how group relationships affect reported results. In exams, questions often test disclosure requirements, not calculations. In this question, the associate is clearly a related party. Even though the transaction was at market price, IAS 24 still requires disclosure. A good answer would mention the relationship, transaction amount, and any outstanding balance, while clarifying that recognition follows other IFRS. To conclude, IAS 24 is all about transparency. It ensures that related party relationships and transactions are clearly disclosed. The standard focuses on disclosure rather than recognition or measurement. Finally, related party transactions must be disclosed regardless of whether they are at market terms. Thank you, and that concludes my presentation. Thank you for your time and attention. If you found this session helpful, feel free to like, share, or subscribe for more lectures on accounting topics.